Financing. Real estate is purchased without paying cash. The property serves as collateral for the loan. Mortgage. Borrower holds the title. Lion theory. Deed of trust. Third party holds the title until the debt is paid. Title theory. Land contract. Seller financing. The buyer has equitable title and the seller keeps legal title until the debt is paid. Financial institutions, banks, insurance companies, etc. They take in deposits and loan deposited funds for a return. Federal Reserve System, central banking system that regulates banks in the U.S. Primary mortgage market, direct lenders. They originate and service loans. Secondary mortgage market, financial institutions that buy and sell existing loans. Loan application process. Borrower should complete a standard federal form, FNMA 1003. Collateral. Property is pledged as security for the repayment of a debt. Qualifying borrowers and collateral. Lenders analyze the borrower's ability to repay debt, credit, employment, appraisal, etc. Pre-qualification, an informal estimate of the amount that a borrower can afford. Pre-approval, a conditional commitment to lend to a specific borrower. Loan-to-value ratio, LTV, ratio between a mortgage loan amount and the sales price or appraised value, whichever is lower. LTV, or Chico's loan amount per property value. Interest, the cost of borrowing money, annual percentage rate, APR, the cost of credit, expressed as a yearly rate. Rate lock. Lenders promise to hold a specific interest rate for a specified period of time. Usury, charging an interest rate that is higher than what the law allows. Discount points, additional fees charged by the lender for below-market interest rates, paid as a lump sum at closing. 1 discount point, 1% of the loan amount. In general, 8 discount points will reduce the interest rate by 1%, 0.125% per point. Reserve account, account that holds future payments for taxes, hazard insurance, etc. Pity, principal, interest, taxes, and insurance, the total monthly payment on a mortgage. Equity, cash value of property after deducting all debts, like the mortgage. Home equity loans, loan that uses the home equity as collateral for additional debt. Reduction certificate, certifies the status of a loan as of a certain date, lists the remaining balance, interest rate, and date of maturity. Leverage, using borrowed funds to purchase an asset. Hypothecation, pledging an asset, real estate, as collateral while retaining title and possession. Liquid asset, liquidity. An asset that may be converted quickly into cash, gold. Real estate is a non-liquid asset. Intermediation, financial institutions invest deposited funds by making loans. Disintermediation, individuals invest their own money instead of depositing it in a bank. A lender advertises 80% LTV conventional loans. 80% is based on the appraised value selling price buyer's income, either 1 or 2. Answer 4. Difficulty. Easy PSI. Topic, subtopic, financing general concepts. Trap. This question tests you on the loan-to-value LTV concept and your ability to identify acronyms common to real estate like LTV. Explanation. The loan-to-value LTV ratio calculation is always based on the appraised value of real estate or the selling price, whichever is lower. Basic interest options. Fixed rate mortgage. Interest rate stays the same for the term of the mortgage. Adjustable rate mortgage, ARM. Lender adjusts the interest rate at certain intervals and according to certain factors. Basic payment options, amortization. Fully amortized, regular equal payments, results in a zero balance by the last scheduled payment. Partially amortized, fixed payments that cover a portion of the principal, interest. Final payment is larger than any previous payment. Negatively amortized. Fixed payments that only cover a portion of the accrued interest. To control payments, graduated payment mortgage, fixed rate loan where initial payments are negatively amortized, later payments are fully amortized, reverse annuity mortgage, lender makes tax-free payments to an owner based on accumulated equity, never exceeds the value of the home, interest. Only mortgage, borrower only pays interest during the life of the loan. The principal is due at the end of the loan term. To control interest, renegotiable rate mortgage. Long-term loan with short-term renewal periods where interest rates are renegotiated. Buy-down mortgage. Lender is prepaid a portion of the mortgage interest rate to reduce the buyer's monthly payments for a short period of time. For new construction loan, story loan. Short-term loan used by builders, developers, and contractors to finance new construction. Blanket mortgage, used by developers to purchase one large parcel, which will then be subdivided into individual lots for resale. Package mortgage, borrower pledges personal and real property as collateral for the mortgage. For risky loans, shared appreciation mortgage, money is loaned at below market interest rates. In exchange, the lender will receive a share of future profit when the property sells. Purchase money. Mortgage, seller financing. Usually seen when the buyer can't qualify for an institutional mortgage at the full purchase amount. Loans that include, or are subordinate to, other loans. Junior mortgage, a mortgage that is subordinate to another mortgage. Wraparound mortgage, a junior mortgage whose balance includes newly borrowed funds, plus the balance on an older pre-existing mortgage. Home equity loans, uses established equity in the home as collateral for additional debt. Loans that include or are subordinate to other loans. Open-end mortgage, similar to an open line of credit. Owner can borrow up to a max amount at any time. Assumable, non-assumable mortgage. Lenders may agree to transfer the seller's old loan to the buyer. A loan with constant payments, where increasing amounts are credited to the principal and decreasing amounts are charged for interest, is called a variable constant loan, a variable loan, a straight loan, an amortized loan. Answer 4. Difficulty, easy PSI, topic, subtopic, financing types of loans. Trap, once again, this is a question that tests you on a definition. However, it does not offer the perfect answer, which forces you to identify and settle for the best answer. Explanation. A fully amortized loan has a fixed payment for the life of the loan. The amount paid to principal increases and the amount paid to interest decreases with each succeeding payment. While fully amortized is not a choice, amortized is the best choice because it is consistent with the correct answer, unlike the other choices. Seller financing. A seller can finance a sale by lending money directly to the buyer. Purchase money mortgage, PMM, mortgage between a seller and a buyer. Land contract, contract for deed. The buyer receives equitable title, and the seller retains legal title until the debt is paid in full. Primary mortgage market. Lenders supply cash directly to borrowers. Primary market activities, loan origination. Primary market participants provide cash directly to borrowers. Loan servicing, collecting loan payments, dispersing funds from escrow, handling delinquencies, and releasing mortgage loans in exchange for a collection fee. Types of primary market loans. Conventional loans, loans originated without government insurance or guarantees. Down payments, amount of the purchase price that a borrower must pay in cash, usually 20%. Private mortgage insurance, PMI, paid by the borrower to offset the lender's risk of a default, required if loan has a high LTV, 80%. Types of primary market loans, conventional loans. Optional PMI cancellation. Borrower may cancel when the balance drops to 80% LTV. Automatic PMI cancellation. Lender must cancel when the balance drops to 78% LTV, 77% for high-risk loans. Government-backed loans. Loans that are backed by government insurance or guarantees. Types of primary market lenders. Commercial banks. Specialize in business loans and mortgages, funded by checking accounts. Savings and loans. S&Ls. Specialize in conventional and government-backed mortgages, funded by savings deposits. Mortgage bankers. Sell loans to the secondary market, but still service loans that they originated. Funded by commercial sources. Insurance companies. Originati mortgages. Secondary mortgage market. Purchases loans from primary lenders. Fannie Mae, FNMA. Generates funds for primary lenders by buying and selling FHA, VA, and conventional mortgages. Ginnie Mae, GNMA. Operates the federal subsidy housing loan programs. Freddie Mac, FHLMC. Organized to borrow money from pension and trust funds in order to purchase and pool mortgages for investment. Which of the following entities make direct mortgage loans available to prospective borrowers? Mortgage brokers, commercial banks, life insurance companies, all of the above. Answer 4. Difficulty, very hard. PSI topic, subtopic, financing sources of loan money. Trap. This question uses very tricky wording intended to tempt you into an assumption. Note that the question asks you to identify entities that make direct loans available, not entities that make direct loans. While arguably unfair, this type of question illustrates just how difficult, tricky exam questions can be. Explanation. All of the listed choices except mortgage brokers make direct loans. However, mortgage brokers, in addition to the other choices, make direct loans available by matching lenders with buyers. FHA loans. The FHA insures but does not originate long-term loans from approved primary market lenders. Principal advantage, lower down payments. Basic standards. Borrowers must purchase FHA mortgage insurance. Premiums. Borrower pays an upfront premium at closing, 1.75% of the loan amount. After, they will pay a regular monthly premium, 0.45% to 1.05%. The exact amount depends on the LTV. FHA loans, basic standards, CONT. FHA mortgage insurance premiums terminate based on the LTV ratio. LTV, 90%. For mortgages with an LTV greater than 90%, premiums will be collected until the end of the loan term. LTV, 90%. For mortgages with an LTV less than or equal to 90%, premiums will be collected until the end of the loan term or 11 years, whichever is sooner. FHA loans, basic standards, CONTES. An FHA borrower should meet specified criteria. Income, must have steady income for at least 2 years. Debt-to-income ratio, generally limited to 31% for housing costs and 43% for housing expenses and other long-term debt. Credit score. FHA is more forgiving than conventional lenders on the borrower's credit score or lack of credit history. FHA loans, basic standards, CONTES, qualifying. Collateral, lender must use an FHA qualified appraiser when estimating the value and condition of the property. Maximum loan amounts. HUD sets limits on the maximum loan amount that it will insure, based on average home values in the area. Closing costs. FHA defines allowable closing costs, which are established as reasonable for the local area. VA loans. The Dept of Veterans Affairs guarantees primary market loans for veterans to build, purchase, or refinance homes. Principal advantage. Little to no down payment. Not required to pay mortgage insurance. Basic standards. The VA will guarantee a certain amount, basic entitlement. From there, the lender decides on the max loan amount and interest rate. VA loans. Basic standards, CONT. Borrowers should to meet certain criteria to qualify for a VA loan. Active duty, Borrowers must serve a minimum amount of time, no dishonorable discharge. This is set at 90 days in wartime and 181 days in peacetime. Certificate of eligibility. If a borrower is qualified, the VA informs the lender by providing a certificate of eligibility. VA Loans Basic Standards, CONT. Qualifying collateral. The lender must use a VA-approved appraiser when estimating the property value. Closing costs. The VA limits amount of closing costs that a veteran may incur. Funding fee. The VA charges a first-time funding fee of 2.15%. Subsequent loans increase to a 3.30% fee. Assumption. VA loans are assumable, even by non-veterans, and may be prepaid without penalty. VA loans, direct loans. VA will only originate loans in extreme circumstances, where there is no source of local funding. Rural loans. The Rural Housing Service, RHS, originates and guarantees loans to farm and rural areas. The maximum amount of a VA guaranteed loan is nationally uniform, determined by lenders set by the VA, established regionally. Answer 2. Difficulty. Medium PSI. Topic or subtopic. Financing. Government programs. Trap. This question probes a very fine point, which may be irrelevant in practice. However, practicality is not always the focus of the exam. Explanation. The amount of guarantee is determined by the VA, but the amount of the loan is determined by the lender. That is, a lender is always free to lend more money than the VA will guarantee. Financing instrument that creates a voluntary lien until or unless the borrower repays a loan. Number of parties. Mortgage, 2 parties, the borrower and lender. Deed of trust, DOT, 3 parties, the borrower, lender, and a neutral third person, trustee. Status of title mortgage. Borrower retains title to the property. The lender takes a lien on the property, which is enforced if the borrower defaults, foreclosure. Deed of trust, DOT. A neutral third person holds title until the loan is paid in full. If the borrower defaults, the trustee may sell the property. The borrower defaults, so his lender wants to sell the property to pay off that debt. Mortgage judicial foreclosure. Lender sues the borrower to force a sale of property, public auction. Right of redemption. Borrower has a short period to pay things off and reclaim the property. Strict foreclosure. Borrower has a strict deadline to pay things off. No redemption rights. The borrower defaults, so his lender wants to sell the property to pay off that debt. Deed of trust, compared to a mortgage, faster and cheaper than judicial foreclosures. Trustee can sell property after the lender provides evidence of a default. No right of redemption. Unlike lien theory states, there is no right of redemption. The borrower defaults, so his lender wants to sell the property to pay off that debt. Both mortgages and DOTs excess funds. Borrower receives any excess funds. Deficiency judgment. If property sells for less than what is owed, the lender can sue for the rest. Deed in lieu of foreclosure. Lender agrees to accept less than the full amount owed. Covenants in a mortgage. DOT covenant to pay indebtedness. Borrower promises to pay according to agreed upon terms. Covenant to pay insurance. Borrower will have property insurance since it's used as collateral. Covenant to pay. Taxes. Borrower will pay any property taxes since a tax lien has higher priority. Covenant of good repair. Borrower will keep the property in good condition. Clauses in a mortgage. Saneringsdautie acceleration clause. The entire balance is due if the borrower violates any covenants of the loan. Alienation clause. A due on sale clause. Lender may demand the entire balance if the borrower transfers their ownership, title, or interest. Defeasance clause. Authorizes the cancellation of the loan after it's paid in full. Clauses in a mortgage. DOT prepayment clause. States if there is a penalty for paying the loan off early. Subordination clause. states that a junior mortgage will always have a lower priority. Power of sale. Clause allows a trustee to sell the property in case of default. Exculpatory clause states that the lender waives any rights to a deficiency judgment. Substituting borrowers when the buyer finances property under an existing loan. Assumption: the buyer assumes responsibility for an existing mortgage, DOT. If he defaults, the original borrower is also liable for the debt. Subject to: the buyer is not liable for payment of the existing loan. In case of default, he might lose the property, but cannot be sued by the lender.